All right, it looks like we're at time today, so we'll go ahead and get started. My name is Chinda Chun, and I'm with NACVA and the Consultants Training Institute. Before we get started with the Around the Valuation World webcast today, I want to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during today's webinar. CP certificates will be available to subscribers to the APW webcast for CPE within 7 to 10 business days. If you're not a subscriber yet and you want CPE, please feel free to click on the link in the materials, and that will guide you to the page where you can purchase the subscription. There's our editors and correspondents for the show today. And with that, I'm going to turn the time over to Alina, who can get us started.
Hi, Mel. Mel is here with us today.
Hey there. Hi, Alina. How are you?
Hi, I'm doing well, thanks. Great having you today.
Good. Well, we've got a great program today. Again, we're going to kick off again with Michael Gregory. Always fun. Great industry highlights to start our day and start to look deeper into some of the things. Then the next session is going to be Carla Nunes and James Harrington and Lari Masten talking about, can you stump the experts? It's really cost of capital questions, which is probably one of the hottest topics and difficult things that we deal with. And then we'll move into the body of knowledge with BVFLS, strategic power of company-specific risk. And then we'll do another panel with our judges, Janae, Castell, having a conversation with the judges. What do judges really think about us as experts and everything? And then we'll close it off with 2 sessions. One looking at the healthcare valuation industry updates with Jessica Bailey-Wheaton and Todd Zigrang, and Will Casserly will bring us home with how do you grow and build your brand? How do you become an industry leader? So with that, let's jump to Michael Gregory. Are you in the house?
I am. It's my pleasure.
All right,
to be
Michael.
Here.
Well, welcome back. This is always fun, Michael. For those of you that don't know Michael, and you should, he is a constant, regular contributor to AVW as well as the valuation industry. He is a mediator, has written multiple books, and a resource to the industry, but also you here, and he'll talk about that too. So, Michael, take it away.
Okay, thank you very much, Mel. It's my pleasure to be here again today. We'll run through a number of different things for this core body of knowledge. These are a number of different articles I'm just bringing to your attention. Just a quick soundbite on each one. Adjusting for WACC for ESG plus or minus up to a maximum of 100 basis points is proposed. BV firms rank most effective marketing techniques. Another case of lopsided valuation experts. NACFA CEO was blown away by ChatGPT. 2023 Stout restricted stock study is now available. The Department of Labor ESOP valuation regs are coming by the end of this year. You'll have an opportunity to comment on those. And private company EBITDA multiples are up in the second quarter of 2023. So in terms of objectives today, recognize the potential adjustment to WACC for ESG, apply the most effective marketing techniques, distinguish lessons learned from lopsided experts, compare ChatGPT expectations by Parnell Black, and I'll offer some of my own. Recognize new Stout restricted stock study company guide is now available. Recognize the Department of Labor ESOP proposed regs are coming soon, and identify private company EBITDA multiples are up in the second quarter. So on the first topic in here, adjusting WACC and ESG. Now this is for a maximum of 100 basis points. And this is looking at a study that was done in Europe. It's looking at, again, ESG, environmental, social, and governance. And so the comment is when you're looking at financial reporting, and with the study that's been done here, they said, minor adjustments might be plus or minus 10 basis points. If you have a material issue, it could be 50 basis points, minor issues, 10 basis points. And it also is commenting that in some cases, there may be no changes in this. And in fact, it's going to relate to the industry you're in. Certain industries are, quote, cool to be in, and other industries are not so cool to be in. So it might be just the folks who are investing in these are causing this to go up in a given industry because of it's being cool to be in. And there's a study associated with this, Valuation and Sustainability, a guide to include ESG data. It's edited by Dejan Glavis, And we have a link to that back in the reference section of this particular presentation. Then BV firms' effective marketing techniques. So the most effective technique is one-on-one. I know when I started my firm, I reached out to 5 mentors. It's now over 10 years ago. And one of them said, Mike, you got to get in front of 5 people a week. And I said, how the heck do I do that? And I worked with him to figure out how to outreach to different people. And it still stands as the best way to work is have a one-on-one with someone else. That was either found to be very effective or found to be moderately effective by a majority of the individuals. This is a preliminary report from BVR on over 200 firms. And then the second thing is to look at what can you cross-market. So depending on what you do, could you be involved with other things? And how can you make yourself visible? One is like, for example, public speaking. When you attend events, networking with other people, what you have on your website, and those types of sources. So we always have to think about marketing and how are we going to get others who have an interest in what we do and how we might expand our clientele. Well, here's a lopsided case relative to valuation. I happen to be in Minnesota and happens to be a Minnesota case, but I didn't pick it out for that reason. I picked it out because the court looked at this and said, you know, there's a real perception relative to appraisers that you are hired guns. In this case, the husband's expert said it's worth over $100,000 for the business. The wife's expert said it's worth over $5 million. And the court gave the husband's expert very little evidentiary weight. Well, in fact, what they said is we're not giving it any weight, but that was a polite way of saying it. And the husband expert said, we're going to look at 1 year and we're going to look at some things that were not realistic. That appraisal looked at or ignored $14 million in performance fees over the last 4 years, was looking at a margin that was very low. Operating income did not make sense. And even the dividends were 9 times greater than what the value of the firm was. So when you stand back and look at this, the court's going to look at this and say, that was not reasonable. I know when I ran an expert witness group with 21 experts, I said, we always want to come off as being reasonable. So we take our reports and then review them and say, how far can we go the other way? So if my client wants a high value, how far can I go the other way to make it a lower value? Or if my client wants a low value, how much further can I go to make this a higher value? So let's go back and critique the variables, because whoever is most reasonable is going to win before that judge. Just something to think about in terms of this, what the inferences are from this case. NACFA blown away by ChatGPT. I read this article about David Fine of ValueSource, gave a demo to our CEO, Parnell Black. And Parnell came back and said, I am just blown away at what could come up in just a minute when we want to say we want to put a job posting out why NACFA is a great place to work. Well, personally, I took this and I blog every week on my website. So I took my blog topic for the next week and I said, I'm going to try this with ChatGPT and see what comes up. And what I found out is I'm looking for a 1,000-word blog, and my blog came up at about 500, but about 2/3 of what was there was right, and about 1/3 of what was there was wrong. So I actually went with this, and then I expanded it to get to my 1,000 words and included a number of other sources. By the time I got done, I said, it was kind of a wash. I just did my own research on this. It was kind of a wash. But on the other hand, this is the up and coming element. And if you haven't even tried or played with ChatGPT, you might want to do that relative to some other things like this, the job posting for NACFA, why it's a great place to work. And then how might you want to modify that or expand on that? In his case, it basically gave NACFA everything they wanted. So just sharing that with you. Stout Restricted Stock Guide is now available, and you can get the guide to the Stout Restricted Stock Studies. That's available to everyone. It's free, and I have a link to that. So you can get the companion guide, and it's the most widely used restricted stock transaction database for determining DLOMs. Basically, it's Stout and then taking a look at Plurus are the 2 most often used data sources on just raw data looking at DLOM studies. And then the DLOM ESOP regulation, valuation regs are coming by the year end. Now, this is important if you're involved with ESOPs. You may not think it's so important to comment on proposed regs. I worked for the Treasury for 28 years, and I'll tell you, every comment is read. Every comment is considered. So these are going to be out by year end, according to the National Center for Employee Owners. And once that does come out, they'll offer a comment period of 60 to 90 days. And if you're involved with discounts for lack of, if you're involved with ESOP valuations with the Department of Labor, you might want to check that out. And they're commenting they're going to be serious this time. They came up with proposed regs in 74 and they didn't do anything with those. But this time, having lost a court case, they're making administrative decisions consistent with that case. You might want to just make comments on the proposed regs when they come out. And finally, private company EBITDA, they're up in the second quarter of 2023. You can see how the numbers have jumped. I'm just going to go to the graph on the next slide. If you look on the far right, you can see that overall it's jumped to a number of 4.0 from 3.2 last quarter, and that the overall trending, looking at the 3-month average, is just over 3.5. So it says we're going up. I know a number of folks that said we may have a recession or a small recession by the end of next year, and we'll just have to see how that goes. But just bringing these all to your attention. In terms of resources, here's the Valuation and Sustainability, a guide to include environmental, social, and governance data in business valuation. Again, this is financial reporting, and it's from Europe. Minnesota case, Tenenbaum versus Dashpandy, and that points out that the husband's valuer did not provide a very reasonable determination. Last quarterly message from Parnell Black, you can see that. Stout Restricted Stock Study Guide, and that's free. And as you know, each month I look at certain sources, and these are the different sources I look at each month. And my intention is to provide you with some quick sound bites on some of the current trends. And then, of course, I always say, if I can help you in any way, come back to me. Last week, I had 3 people contact me who said, I see you on AVW and I have a question or comment. And 2 of them I was able to help, and 1 of them I sent them on to someone else who I know was an expert in that area. So if I can help you in any way, there's my number, there's my email. I'm always happy to help. And with that, I'm going to turn it back over to Mel and Elena. Thank you.
Thank you, Mike. Thank you for all the information. We have in front of us our first polling question, so make sure you respond to that. And then now we have our next session that is called Can You Stump the Expert? Ask your cost of capital questions live. So I have my notes. I'm ready to take notes. And of course, you can watch the show later on YouTube, so it's okay, but I'm ready for that. And in this particular segment, we have Carla Nunes and James Harrington. They are with Kroll, and they both co-authored the Evaluation Handbook. And we also have Lari Masten. You know, everyone knows her. She's amazing too. So I'm gonna let her talk to you, let them talk to you, so they can start their presentation. Welcome, everyone.
Thank you, Alina. Appreciate that. And thank you, everyone, for your time. We are going to be with Carla and Jim talking about anything cost of capital. That's kind of our topic. Now, last week, just a quick couple of comments. Last week, we sent out a short survey of questions. Basically, you know, what questions do you have related to cost of capital? And we clearly don't, we have 16 areas that we, you know, came up with, and we don't have time to cover all of them in this Around the Valuation World venue. We've only got 20 minutes. We couldn't give them justice. So we do have a few topics that kind of rose to the top. We are going to talk about items relating to consistency in our assumptions in that cost of capital, sources of economic data to kind of look to during periods that we're experiencing right now, where the economic indicators are kind of in flux and all over the place. And then we are going to talk about size effect. That's what we're going to trying to capture today. So welcome again, Carla and Jim, and thank you both for your time today as well. I know that you're really busy. I know our audience is familiar with you, so we're going to just jump straight into our first topic. And the topic is, we'll pick the top one regarding consistency in our cost of capital assumptions, and knowing how to maintain that consistency, basically, when we're using the navigator. Carla, can I point to you first and get us started on this?
Thank you, Lari. Yeah, and thank you, everyone, for joining us this morning. So as Lari said, this is just a teaser. Like, we'll have other topics in our free webinar this afternoon. So the first one, we thought, we were discussing this last week, and Lari and Jim and I were thinking, well, do people use some of the navigator assumptions internally consistent with each other? So we thought, why don't I just share a little snippet of the navigator? So I'm going to stop sharing this and share something else. And just to ensure that we're actually consistent with what we use. So we can use, there's lots of data in the Navigator that you use in terms of cost of capital, but at times we are not sure if we're doing the right thing with each other. And so let me just quickly go to my website, just making sure that this does it, and share my screen. And let's go to this. So in the Navigator, when we get to, and I apologize because I X'd out of the Navigator, so doing live sessions is always an issue. So when we get to the Navigator, and let's say you were doing a cost of capital, and there are different estimates for a size premium. So if I was to start an estimate today, and I said, oh, today I'm doing an ECFA, estimate, and it's going to be, October 16, and just save my estimate. And I have two types of major studies that try to estimate size. So I'm going to first do just like a valuation date here that is like year end, just because sometimes that's, let me see, like 2021, where we had different issues of like consistency, that it's better to see that way. So, so we have two types of size studies that we have in the Navigator. One is the CRISP and CRISP decile size study. And really, this was the one that used to be published in the SBBI book, right? It was the before we did this, Morningstar was doing it. And before Morningstar was doing it, was Ibbotson Associates. Now, Jim, who is like here joining us, he worked directly with Roger Ibbotson, the professor at Yale who wrote the paper and started publishing the books. He wrote directly with Roger and putting these studies together, the CRISP decile size study, which was called something else at the time. It was like the Ibbotson. And then he was also at Morningstar, and then we're now lucky to have him at Kroll, formerly Duff and Phelps. So anyway, so that's like the traditional study. The other study is the risk premium report, which is Roger Grabowski had been putting it together for a number of years, like with a different methodology, but also allowing you to have different metrics for size, which is actually very useful for companies that are not traded. So a question that was being asked was, well, if I choose a certain risk-free rate and equity risk premium, does it have to be consistent across both studies? So for example, let me just say that here, I wanted to pick a spot risk-free rate instead of the Kroll's normalized. And I picked a spot 20-year yield risk-free rate for this CRISP size study. And then automatically the Navigator tells me, okay, you have to pick an internally consistent equity risk premium. So it's not allowing you to select the Kroll recommended equity risk premium in this case, because it's saying, hey, with the spot rate as of this valuation date, and that's critical, this valuation date that I picked was December 31st, 2021. And so, okay, I have two choices. I can either use the historical long-term or the supply side long-term. So let's just say I pick the supply side long-term, and we actually we talk more about equity risk premium in the longer session this afternoon. And for simplification, I'm just going to pick a beta of 1, so it's the market, so that we can just see the results back to back. So this would tell me, and I hope you guys are seeing. I need to share my screen for the size premium. Let's just say that my company was $100 million in, which I think it's actually a lot of the companies this audience may deal with is actually less than $100 million, but let's just say it was $100 million in equity, estimated equity. So just for us to see what it looks like using this study. So if I did this, this would give me a cost of equity capital of about 13%, which is actually fairly low, right? For a undiversified small company. But this is what the systematic, market data would give us. Now, if I go to the risk premium report and say like, oh, in the risk premium report, maybe I want to use a different risk-free rate. Maybe I want to use like the recommended, like the ERP and the normalized risk-free rate for that Kroll/Duff and Phelps used to put out. Now, what this is going to do is it's going to change. If I do this, it's going to change everything. So if I do that, that means that I need to select a different equity risk premium to be internally consistent. And what that does is, it will change it throughout. So we will change it for both studies. So now you're saying 2.5 and 5.5. If I go back to the CRISP decile size study, it made that change as well. And so you're thinking, wait, I wanted to use a different risk-free rate and a different equity risk premium. How come it's forcing me to do this? Well, this is exactly what we're trying to say. You need to be internally consistent among the estimates. Now, you can run a second scenario if you want to see what it would look like with a different risk-free rate and a different equity risk premium estimate. But the point here is that when you're running through the navigator, you want to make sure that your risk-free rate and your equity risk premium assumptions are internally consistent across both size studies. And then if you want to run a different scenario with a different risk-free rates and equity risk premium pair, you can do that. But again, that would be a second scenario. So here for my risk premium report, now I would be consistent with 2.5 and 5.5. And if I pick here my beta, my apologies, if I pick a beta of 1 here, just to be consistent as well, it doesn't have to be, but if I do this, then I would get something more like 13.84 using this measure of size. Jim, do you want to comment something on this, on the internal consistency?
Yeah, internal consistency errors are one of the most frequent common errors that people make. A real easy one to make is if you're using a sum beta for your company or your industry, you should use a size premia that was also derived using a sum beta. Alternatively, if you're just using a OLS beta, just a plain Jane beta for your company or your industry, you should use a size premia that was developed using an OLS beta. They are different, but it just makes it very consistent. In this case, Carla's talking about using the same, making sure that if you're going to be presenting two different models, well, try to make them consistent by using the same risk premium and same ERP. Now, if you want to run another set of 2 using a different ERP and different risk-free rate, go ahead. But always in those pairs, if you're going to have something, if you do the CRISP decile size study and the risk premium report, it's always a good idea to make sure that you're using the same equity risk premium and risk-free rate between them. If you want to run it the other way, go ahead. But internal consistency, we even see that in international things. And I don't want to get into international, but oftentimes people mix up, the currencies of their cash flows. They use an ERP that's based in USD, but then their cash flows are in a different currency. And you see that all goes back to this internal consistency. Make sure things line up is all we're saying.
Now, one of the things that, along with this, now first, this is not a marketing, segment on the Kroll Navigator, but we've got the experts that are here. So kind of along these same lines, though, part of the inputs that are missing is there's not a space to put in that company-specific risk premium, which we aren't going to have time to address during this session, but in our longer session this afternoon, we'll address that. But also along with that is this arrives at our discount rate, and we need to develop generally a capitalization rate, which requires us to kind of assess this long-term growth piece of it. Now, Carla, along with looking at the consistency of our risk-free rate, number one, right now I'm under the impression, and it has been announced that Kroll is actually suggesting that we do not use, we use the higher of the recommended risk-free rate or the spot rate. So right now, it's the spot rate is higher than the recommended rate, correct? So we should not be running it both ways currently if we have a current valuation, correct?
Correct. And that's a great point, because for many years when we were normalizing the risk-free rates, and Roger was the one who first started doing it, but now others have followed, including McKinsey. The issue there is that it was an environment where we deemed the actions of the Fed to be impacting the market. So a non-market participant was artificially driving rates down. We're now in a situation where the Fed finally reversed that policy, and they're actually increasing interest rates, and they're no longer buying additional bonds and treasuries, mortgage-backed securities to drive interest rates down. In fact, that's the opposite. Now they want interest rates to be higher so that they are able to control inflation. So we're in a transition environment where we're saying higher of, but we expect to actually transition to finally say, like, we no longer need a normalized rate. We'll keep looking at it just to make sure the fundamentals are there, but really, like, we're finally back to the global financial crisis era, where you just using like your spot rate. Now there are different questions on how volatile it has been, and I've gotten a lot of questions on that from our project teams, and whether they should do like a weekly average or a monthly average to mitigate some of that really large volatility we've been seeing on a daily basis. But for sure, for now we're like in a world that we think will be able to transition away from the normalized risk rates to a spot rate.
Okay, so let's turn a little bit to, we'll skip over company specific risk, but let's turn to that sustainable growth concept, because we do have a lot of flux going on right now, and there's a lot of information out there that seems to be contradicting each other, but they're all looking at the same data. So help us out here with, things like GDP, CPI, like, what are you doing? What can we do now? Because it's like all over the board with what these rates should be.
Lari, that's like an excellent question. In fact, we started doing this analysis after COVID, because what happened after COVID, like, it was just so uncertain what was going to be the impact on the economy, that we started to see like very, very different estimates by reputable economic sources, and they were so different. It was like, and you're thinking as a valuation specialist, you're like, what do I pick? Whose opinion should I rely on? And so we started saying, well, maybe everyone is going to be wrong. I'm sorry. Like, and my husband is an economist. It's like, you're going to be wrong. The question is, like, can we mitigate some of that like variability by taking a median of various estimates from reputable sources? So we started doing that, but just to give you a sense of how different they are, this is what I'm showing on the screen right now is the projected real GDP growth for Q3. So the Q3 that we just ended, these were estimates as of September 29. So just at the end of the quarter, we are going to show you estimates by two Federal Reserve Bank regional feds. So these are the regional feds, they advise our central bank, the Federal Reserve Board, on economic policy, right? And they have different models. So this is from the Federal Reserve Bank of Atlanta. And they thought that in Q3, our GDP for the United States has grown 4.9% annualized, okay? 4.9, look at that number. Now, the Federal Reserve Bank of New York, exactly as of the same date, with their model, looking at the same data, they think that in Q3, our economy has grown at 2.1%. So 2.1% versus 4.9, they're like more than double, right? And so like, who's the forecast to use, right? And it's the kind. This is just an example of how difficult it is to square the round holes, So for short-term estimates, there are more sources out there. Some of them are free. But we started looking at these. So, like IMF, OECD, World Bank, those are all free. Then there's some that are actually paid, like blue chips, they're very reputable blue chip economic indicators, Consensus Economics, Economist Intelligence Unit. But you have a couple of others that are also free, like Fitch Ratings and Moody's Analytics. You can sign up and get their numbers. You need to know where to look. And they usually do it. Moody's Analytics every month, Fitch Ratings every quarter. S&P also every quarter. Usually you can get like their data for free. So some of these are, as I said, some of these are combinations of paid versus unpaid sources, but we're trying to give this to people. And so as a result, you can see like by taking a median of all of those sources, we are getting like the short-term forecast for the United States. So in this example, which was the latest update that we did mid-September, we were 2% for the United States in 2023, and then in 2024, 1%. Now, mind you that at the beginning of this year, these same exact sources, they thought 2023 was going to be, more like 1%. It was actually at one point it was 0.5%. So like the estimates have grown by 1.5%, and so that's huge. Like if you're looking at the budget for for a company that you're valuing, and you're looking at their budget, and you want to compare and contrast of like how the overall economy is growing. Really hard, right, to tell. Like even with looking at economic sources, is like how do I benchmark? How is it? And now they're like saying, well, because the economy has been more resilient in 2023 than we thought, that means in 2024 it's going to be slower. Yeah, exactly. So that's the kind of thing that we have to look at. So, but now for the long term, Laura, you asked for the long term. So those were short term. Now for the long term, which matters if you're doing a discounted cash flow approach and you're doing a terminal year, the first thing to think about is like, how does the overall economy grow, and how my company and my industry compares to the overall economy. So we look at some of the same sources. Some are the same, some are different. So for example, in here, we're using Livingston Survey, the Survey of Professional Forecasters, which are free sources. But and the long-term estimates tend to be a little bit more stable. Even then, like you can see a difference between 1.5 to 1.9 for the next 10 years or so. That's how far they forecast it. And the median here is 1.8%. That's for the real growth. So think about you're selling widgets. Like, can I sell more widgets for this firm, or can I keep like my specific company, keep those at zero? I'm not going to sell in the long run more widgets, like more product, but I might be able to get some price appreciation or price pass through to the customers. If that's the case, like you look at the long-term inflation expectations, which is on this screen, there's some additional sources. Some of them, again, are free. Like the term structure, the first one, term structure inflation expectations, that's free. The Federal Reserve Bank of Cleveland, Livingston Survey of Professional Forecasters, University of Michigan, all of these are free. Others are not, but we are showing you here the same consistent period over the next 10 years or so. And here the range is quite wide compared to what it used to be before this bout of inflation, between 2.2 and 2.7, and the median is 2.4. If the Fed is able to control inflation, we might see a decline in this. But for comparison, just so you have a perspective, if you're doing valuations just after COVID, economists were so, worried that the demand for economic activity and demand for products was going to collapse, and prices were going to collapse. And so the same exact estimate back then was 1.6%. That's a huge difference. Like if you're doing a valuation at that point versus doing a valuation now. So if you put it all together, the long-term real GDP forecast and the long-term inflation forecast, this is what you'd expect over the long run, what the long-term growth rate would be for the economy. And so that's when you start doing then your benchmarking. So that 4.2%, that's when you start doing your benchmarking and thinking, can my industry, at what rate is it growing compared to the overall economy? Chances are it's lower than the overall economy, unless you're in tech. And in my company, the one that I'm evaluating or valuing may be growing at an even slower if it's more mature, or at the same rate as the industry. So think of this as, for many industries, this will be a ceiling. So I'm going to pause there.
Excellent. Well, and so Jim, I want to turn to you real quick. So I just literally this morning sent it out, valuation for compliance purposes on a company, saturated the market, no more ability to to expand the company itself. And I used a 2.5% long-term sustainable growth, consistent with what you guys are saying then? A little bit higher than the 2.4, but
yeah.
2.5.
Which, I mean, but it goes back to your point, right? Like it's so saturated, you're not going to be able to sell more units, right? But you might be able to still pass on some of inflationary, some price increases. And so that would be closer to the inflation. That makes sense to me.
Excellent. And our last topic real quick, because we just have 1 minute or two, is about the size effect. So Professor Damodaran is out there basically saying that he doesn't think that there's a size effect. It doesn't exist. We've probably all been exposed to some of the at least articles and things that are being in the BB update and everything out there. So I guess the question is, should we alter the way we do cost of capital and size premiums? Should we alter our opinions of them, the way we use them? Should we be modifying them in some way? Should we be maybe reducing company specific risk if the size premium's not there? What are our options here?
Well, so first of all, and then I'll let Jim comment on his slides because he's done some terrific analysis. But I think that what a lot of times people forget is that when there are papers out there saying that the size is small or does not exist, is in the context of having various risk factors, not just size. So we've been using size as practitioners as a catch-all for risks that are different for small versus large companies. In reality, what academics are looking is at they're looking at various risk factors. So size is an example, but others, market is what the capital asset pricing model, CAPM beta was, but others would be, for example, value. So Fama French, the three-factor model that is famous, Eugene Fama won a Nobel Prize for economics. He still believes size is important. And he says, but there's all these other factors. In fact, now they have a 5-factor model, which takes into account quality and investment. So when people think about, those academics are saying that the size is small, it's small if you also take into account all these other risk factors. Now, in practice, what do we do in valuation? We really don't do that. So I'm going to pass it on to Jim, to just first give a little bit of a mea culpa here from some academics who also said, like Damodaran, that size was dead.
Thanks, Carla. I think we're probably over our 20 minutes, right?
They gave us a few more, so we have okay. 3 more minutes.
Just real quick, I want to comment on the previous question. Should you look at a bunch of things? Yes, especially when uncertainty and volatility increases. Of course, even the experts in times of economic stress or whatever, their opinions are going to diverge even more. They always diverge, but in times of real upset, their opinions are going to diverge even more. And sometimes the experts can be really wrong. As a matter of fact, if you remember, the actual GDP for what was it, 2022 was 2.1. Do you know that and that was what it actually was, but in the fall of 2021, just before 2022, all those experts that Carla talked about, their estimate for 2020, the next year, 2022, was over 4%. 2021, I mean, it was over 4%. It was incredible. Just real quick on the size effect. Here, I like to call this the DMS, Dimson, Martian, Staunton, mea culpa. They've been saying, much like Damodaran, that the size effect doesn't exist, blah, blah, blah. And then all of a sudden, Ironically, after we highlighted the demise of the size effect, US caps, small caps performed very well, and they came out with that in their Credit Suisse Global Investment Returns book. And let's see, can I switch to the next slide? Okay, since we're just about out of time, in general, small stocks outperform large stocks. In this graph right here, everything green that you see represents a start and end date, a start month and an end month. All possible start and end months between January 1926 and December 2022. And there's 678,030 races between small and large stocks. And when small won the race, it's green. When large won the race, it's gray. And you can see that just the sheer number of times that small beat large was really lopsided, 83.9% of the time, as opposed to 16.1% of the time for large. Next slide. Here, size effect concentrated in the smallest companies. Next slide. And we're going to go into this in much greater detail in the webinar this afternoon. You know what? Let's go to the next slide.
Okay.
Because we're out of time.
Yep, you're right.
Here, I was talking about the races between small and large. Okay, the longer the race, the more small tends to win. If you give it time, small catches up and races ahead. So in other words, over there on the left side of the slide, 1 year holding period. If the race is only 1 year, small wins just pretty much even, 51.9, large wins 48.1. But as we increase the holding period, moving to the right of the slide, from 5, 10, 20-year, 30-year holding periods, you can see that the small tends to really dominate as far as the number of times it wins. And let's take a look at the next slide.
And just one little point on that is that when we're valuing a company, and if it's not distressed, if it's a company that we think it's a going concern, the holding period would actually be on the right-hand side, would not be on the left-hand side.
That goes back to our discussion about internal consistency, doesn't it? Okay. Yep. If you're valuing a company that is expected to be around forever, basically, as opposed to a company whose cash flows are going to disappear and go up in smoke after a certain number of time. And there are companies like that, but whatever. But if you're measuring something that's really long-term, okay, a company, you want to use a longer race. It's more consistent. It's internally consistent to use a size premium based upon a long race between small and large when you're measuring a long-term investment. Internally
I
consistent.
could listen to you guys ad nauseum. I love this, geeking out here, but Mel has a timeline to keep as well.
Yeah,
exactly.
Yeah. We're way over. I'm sorry, Mel.
Time.
We went way over.
We did.
Thank you so much.
This was genius work and a whole lot of good stuff. I agree, Larry. And thank you, Carla and James. This is wonderful. So I think there's so much more that we can dig into, and this is what's going to make us and sharpen us as experts in our field, is understanding that and then being able to explain it in a way that people get it.
Yeah. Yep. Tune into the thing this afternoon. We really go into depth in it. It's 100 minutes. Thanks, everyone.
Thank you.
All right, our next polling question is up right now as we get ready for our next session. But before that, I think Chinda's coming on to talk a little bit about the upcoming conference.
Yeah, we just have a quick little announcement just with the conference. Are you able to join us? We do have a little discount. I think it's $150 off till the end of the month. So if you haven't registered yet and you're interested in joining us in Fort Lauderdale or virtually, please feel free to register. The link is in the material, and I'll also add it to the chat in just a moment. But yeah, all right, and then I'll turn back to you, Mel.
All right, thanks, Chinda. Hopefully you get a chance to see you there. I will be there at that conference also, speaking and everything. So let's move on to our next segment. Our next segment is, and Ken, if I butcher your name, I apologize. Ken Sanginario is going to be talking a bit about strategic power of company-specific risk. And so just kind of carrying on in the arena of the rate of return, but the more specific risk. Ken, are you there?
I am, Mel. Thank you. It's Ken Sanginario for
All
everybody.
right. Welcome aboard and good to have you.
Thank you for that. Welcome, everyone. I don't know if my video is, it says the host has turned my video off. So is my video?
Hold on. Let's see if I can, I don't know if I can do that. I don't know that I
Got it.
have.
I think
There you go.
do.
Now
Try
you're there.
again.
I see you.
got it. Okay. And I'll share my screen now, if I may.
Beautiful.
Okay.
It's coming up. It's coming. There you go. You're good now. I'll leave you
Right.
go now.
Okay, perfect. Well, thanks, everyone. Welcome, and thanks for joining and staying on for this next session. It was, I had the pleasure to listen to the last session, and it was absolutely fascinating. So I'll try to keep the bar up close to where they were, although those are tough shoes to fill there. So, but I'd like to spend the next 20 or 25 minutes, if I could, talking about company-specific risk, which, in my opinion, in my world, I think it's one of the most highly valuable, but also one of the most underutilized factors in the whole valuation process. And I say that because it's used, I think there's a lot more use to the company-specific risk factor than people give it credit for and that people use. So typically, company-specific risk, as we all know, it's used in conclusions of value and all kinds of valuation engagements. But in my view, it's using it the way that it's typically used, the way I've seen it used very often, is a lot like eating a boiled egg. It's fine, it serves its purpose, it's sustenance, gets the job done, kind of boring, doesn't really have much impact on anything. But if only we knew a lot more about company-specific risk and could dig into it a lot deeper and really understand the underlying qualitative factors that drive it and know how to use it in a more strategic manner, well, we could use it in a lot of other ways, a lot more strategic ways. We could make a lot bigger impact on our clients and use our valuation skills more strategically and less in a pure compliance manner. So that's what I'd like to speak with you about today. Just the overall premise. Of course, we all know company-specific risk. I'm going to say CSR for the rest of this. CSR is perhaps the single biggest factor in determining cap rates and discount rates. And by definition, it's unique to the subject company that we're valuing or looking at. And because it's so unique, and because by applying more rigor, we could really define a lot of the underlying qualitative attributes in the buildup of CSR, it has the power to transform companies because it is so controllable. If we're building it up using underlying attributes or the lack thereof, then understanding it in more detail makes it incredibly versatile and makes it controllable by the business owner with our help and guidance. So it can be used in a whole host of applications, and we're going to walk through each one of these kind of very quickly. I'm going to give you a Reader's Digest version of all of this. This was a 90-minute presentation that I did at the last NACFA Super Conference out in Salt Lake City. So I'm going to sort of condense it all and go through this really quickly. But of course, if anybody would like to discuss more of it after the session, feel free to reach out to me. I'd love to discuss these things. So let's just start. As everybody knows, CSR has kind of a triple impact on discount rates and cap rates, because not only does it impact the risk-adjusted cost of equity, but it also impacts the risk-adjusted cost of debt and the risk-adjusted capital structure, because the higher the risk of the company, the higher the CSR, the more collateral enhancements that would have to be provided in order to secure debt financing, and those have costs, so they increase the effective cost of debt. And the higher the risk, the more equity weighted the capital structure must be. So all of those components tend to combine in this triple impact. The higher the risk, the lower the value, of course. And it's all from the perspective of an outside investor looking in. So if we can convert CSR from a compliance perspective to more of a strategic perspective, then we can use it a lot more impactfully. And so from a compliance perspective, it tends to be this somewhat fuzzy gray factor that we tend to, look at 5 or 6 or maybe 10 factors and pick a number, pick a factor within a safe harbor range. When I went through my valuation training, I don't know, 14, 15 years ago, the safe harbor was taught to be somewhere between 2 and 8%, which in my opinion often generates too low of a CSR factor, and therefore too high of a value. There's very little documentation that goes around it relative to all of the rest of the documentation and valuation reports. And I think there's a big lost opportunity because of that. But if we can really dig in and build it up in a more rigorous way, build up a more defensible CSR factor, I say 2 to 25%, not 2 to 8%. Well, how do I get to 25%? It's interesting. This sort of tags on a little bit with the size premium that was just discussed in the last session, because from my perspective, I say the size premium for small companies, I stop it at the 10th decile, around the 5% range. I don't add the extra 6 or 7 points to get down to, say, the 10Z level. Instead, I take those 6 or 7 points and I add them to the potential range of CSR. And that expands the range of CSR, because my philosophy is that if there's a small company and they're really well run and really well developed, well, they can avoid some of the risks. They can mitigate some of the risks of being down in that 10Z level. So I use a 2 to 25% range. And if you think about it, if a company is all the way up in the 25% range, if you add that to the risk-free rate and equity risk premium and size premium, then you're likely coming out right around the cost of equity that a venture firm or an angel firm might require. So that's where I get the 25%. It's a more realistic range. If you document it completely, then there are a lot of opportunities to take the documented attributes that you've used to build it up and then use those strategically to help companies not only understand why their value is what it is, but also how to move the needle. So how do we do that? How do we dig in deeper and build up that company-specific risk factor in a more rigorous way? Well, the way we look at it, there are 8 primary functional categories of every company, and different people will give you different categories. Some people will say there are 6 or 7 or 9 or whatever it is, but there's some science behind these 8 that we can get into another time. But planning, leadership, sales, marketing, people, ops, finance, and legal, those are the 8 primary functional categories that we look at in order to build up a CSR factor. And each one of those categories can be subdivided into a series of subcategories. So you see the 8 primary categories, and you see a framework of subcategories. These are sort of standard subcategories that we look at. And then each of these subcategories could have a question set or a way to evaluate and assess the subject company in terms of how well developed are they, how mature are they in each one of these subcategories. And to the extent that they are underdeveloped or immature in any particular category or subcategory, that's adding risk in the process of building up an overall CSR factor. So we have all of these nearly 50 subcategories that we would look at, and it might seem a little overwhelming, but you can assess a company across all of these categories in about somewhere between a half day and a day. So it's not as overwhelming as it might appear, as long as you know kind of how to go about and do that. And the idea is that each one of those primary categories then, by assessing the subcategories, can be assigned an overall quality score. So you see the 8 primary categories and an example here of how a typical company might look. And we see a lot of companies that look something like this, where they have some categories that are more well-developed than others. And it's interesting that companies tend to be strongest in the categories that reflect the backgrounds of their owner or the CEO, and weakest in the categories that are kind of the natural personality opposite areas. And so what they don't realize, though, is that the weakest areas, which are typically their blind spots, those represent their constraints to growth, their constraints to creating value. And I know from all of the years that I spent, about 18 years turning around distressed companies, that if companies continue to grow when they're out of balance like this, without alleviating the weakest areas, the constraint areas, then at some point, some of those weak areas will become fail points and could cause the company to slip into distress. So we like to use the buildup of CSR as a way to point out the weak spots to these companies and then have them work first on improving all of the weakest areas, bringing the company into better balance, and then strengthening the company over time in unison, all of the 8 categories together. And that's how the companies can create value over a period of several years. This is not a quick fix. The flip side of that quality score is the risk score. And the risk score is, it just converts to become the company specific risk factor. So in this example, a risk score of 186 would convert to be an 18.6 CSR. And we advise companies that if they aspire to selling their company in the future or raising capital, they have the highest likelihood of success if they're in the lower half of this thermometer graph. The higher they go, the less likely their chances of successfully selling or raising capital. So I want to just walk through a quick example. Let's say that we have a company that has an 18% CSR in their, as they currently stand, and maybe that results in a premium on their cost of debt, a risk premium because of the CSR being so high of 7.8. These are calibrated estimates that come from tables that we use. And that also shifts their capital structure to be, let's say there's a 20 to 40% debt capacity in the capital structure. And because of their high risk factor, maybe they can only have 25% debt, 75% equity. And all of those convert to generate a cap rate of 22.68%. Well, what if we could reduce that 18% CSR over time, over say 5 years? And again, this is not a quick fix. This isn't something that you just turn on a dime over 3 or 6 months. This is a lifestyle change for a lot of companies that sometimes can take years, but it really has a big impact on the value that they can create. So let's say we can take that 18% and take it down to a 6%. Well, what does that do to the risk premium on their cost of debt? It might almost totally eliminate it. Maybe they're just left with a small risk premium on top of the minimum cost of long-term debt by the time the 5th year has been reached and the CSR is down to 6%. How about the capital structure? Well, maybe now instead of only 25% debt in the capital structure, maybe they can now have 35%. And what does that all do to the cap rate? It essentially cuts it in half, 22 down to 11, which of course doubles the value of the company. Now, keep in mind, we haven't even increased the revenue or the profitability or free cash flows or anything. This is a doubling of value purely by reducing the CSR over time. So what does that do to the overall impact? All right, well, let's say we had $1 million of free cash flows. Our initial value was 4.4 million, but because we cut the cap rate in half, now our value is almost 9.1 million. And that's only if the free cash flows stay the same. But in reality, there's a byproduct. to improving the quality and reducing the risk of companies. The byproduct is that they will naturally generate additional revenue, additional profitability, and additional cash flows. So let's say instead of $1 million, we can grow that $1 million to $2 million as the byproduct. Now we've gone from a $4.4 million value up to an $18 million value. So this is just one example, and this is a realistic example. This isn't sort of pie in the sky. This has been applied to many companies over the last 10 or 12 years that we've been sort of following this approach and seeing these kinds of results. So to walk through some of the applications, I'm going to go through some of these. I have 6 or 7 different sort of categories of ways to use CSR strategically. It's a lot to cover all of the examples, so I may just pick 1 or maybe 2 in each category and just give you an example. But in business valuations, if you approach the CSR development in the way that I've described, you can explain with a lot more detail to a client why the value is what it is and what they can actually do to move the needle. And then if you have the capacity and you have the interest in helping them to implement what they can do to move the needle over time, well, then you can establish a much longer relationship with clients instead of it being a sort of a compliance valuation where you generate the report and you're done, that's the end of the engagement. You could actually use these skills for clients in other than compliance-based engagements, help them understand their value, and then help them over time to increase the value. You can generate a roadmap of actionable recommendations by following this kind of a process and quantify the impact on the value if any of the recommendations are actually implemented. You can calculate the impact on the value in advance of them expending the resources to achieve that recommendation. Litigation support, you can use it as a basis for refuting opposing valuers. And by the way, I've used CSR in almost all of these categories at one point or another, except maybe one that I'll cover in the end. But I have used it in a litigation case within the last year and a half or so outside of court. It was not a court case, but it was used to settle a dispute between owners of a company. So, and it was all based on that kind of rigor in the CSR. In finance strategy, you can really use this in a lot of different ways to help companies optimize their capital structure based on the risk profile that they have, and to help them establish hurdle rates for investments so that they know that that investing in different options that they might have to grow the companies they'll either meet the hurdle rate and create value, or they will fall short of the hurdle rate and either not create value, or maybe in some cases actually erode value. Allocating capital among alternatives. So lots of ways to use it in a finance capacity. In M&A, you can use it in buy side and sell side. I frequently use this on sell side due diligence before a company goes to market, to help the owners understand what the current state of their company is and what they're likely to face if they do go to market and end up in due diligence. What are the issues that will cause the deal to fall apart in due diligence, or maybe get retraded, that kind of thing. So it gives the owners more visibility, and it gives them more options to think about, okay, I'll still go to market now, I'll take my chances, but at least I'll be prepared, prepared to answer to the weaknesses that might get identified. Or sometimes they may say, well, I don't want to leave that much value on the table. I'll step back for a year or two, or maybe longer, and fix some of these weaker areas and capture some of that value that I will otherwise be leaving on the table. In a value growth or value creation or value acceleration kind of engagement, establishing the current state baseline of the company, identifying how much value the owner would like to capture over what period of time, and that creates sort of a future state vision for the owner and for you as their value advisor, and then help them to lay out a roadmap to achieve that future state over time, tracking, monitoring, measuring, and refining the progress as you go. In turnarounds, I come from a turnaround background, and this kind of a process, a standardized but deep dive sort of assessment of company really helps to identify root problems very quickly and efficiently, and gives you the ability to advise owners or their investors on appropriate courses of action. This is one I haven't done. I'm not a banker, I'm not an underwriter, but I have seen banks use this kind of an approach in renewing of long-term term loans and using it in a due diligence capacity. So lots of different ways you can use these. In private equity, I've seen private equity firms use this kind of an approach, both pre-transaction in a due diligence capacity, but also post-transaction to establish a 1 year or 1 to 3 year sort of post-transaction set of priorities for the management team. And I've also seen them use it in a portfolio management capacity where they could apply the same sort of methodology to several companies in their portfolio, and then be able to compare the relative strengths or weaknesses of companies in their portfolio against each other, and then have them have the strengths of one company be sort of replicated across other companies, and the weaknesses alleviated so they can help each other that way. So lots of different ways and different applications. It's, I say CSR, it's much more than a boiled egg. And how would you use it? It's kind of up to you. I think there are lots of ways to be able to use CSR that are very, very seldom taken advantage of today. And I've been using it this way for the last 10 or 12 years very effectively, and we just wanted to share that with the other valuation practitioners. So if there are any questions, feel free to reach out to me anytime. You have my email. I'd love to talk about this. I'd love to answer questions, but I think we're out of time. I tried to do it as quickly as I could.
Yes, you did. Thanks, Ken. Great information for everyone. So we have our polling question. And next, we have our recurrent session that is called, is with the judges. And it's called this time, What is the Judge Really Thinking? And today we have Janae Castell. She's one of our correspondents. She is, a specialized business valuation expert. She does a lot of personal goodwill, works with startup. So she's been with us for a long time, and she's going to be doing the presentation of the judges and starting this session. Janae.
Great, thanks. I'm happy to be here with you guys and with the judges to get our session going. I see Ken. Have we had the judges on yet? I see them jump on.
Yes, we have the three judges with us already.
Great. Oh, yes, I see. All right, great. I see Yates, Platts, and Driscoll in the list now. Thank you. Okay, so I'd like to talk today a little bit about what the judge may be really thinking. I'm sure, judges, you've had moments when an expert is on the stand where you may be thinking the inverse, what is this expert thinking? But if you could give us some background on maybe how you're reacting and what's really going on while we're up on the stand, or even maybe watching another expert on the stand, maybe the opposing expert, and kind of getting into your heads and seeing how we can do our jobs better, and how what we do and what the attorneys do and just things that happen in the courtroom, how those impact us.
Well,
So
let's start with what is a judge, right? You expect a judge to be attentive. You expect a judge to listen. And being a judge means you're never getting an adrenaline rush in the courtroom. All of you get that adrenaline rush when you testify, or get that adrenaline rush when you're explaining to your client, and all of a sudden the client understands what you're saying, or you get the adrenaline rush in the courtroom when the judge is nodding her head. We don't get that adrenaline rush. And so we just start, you start with that it's a job it's a lot harder than it looks. It's the best job I've ever had in 56 years on this good earth. It's the hardest job I've had. in 33 years of employment. So I think it's so important just to start with that. The judge is sitting there. The judge can't get up and stretch. The judge doesn't have a lot of blood flow going on. So immediately, if you're causing the judge to lose blood flow by being boring, that's not a good thing. And we hear so many great presenters monthly at ABW. Just heard Ken with the boiled egg. I don't eat boiled eggs, but I wanted to have one after I saw what he was talking about. It was great. It was interesting. So I think the starting point is we are all storytellers. A trial is just an evolution of telling stories around the campfire. Be able to be interesting so that the trier of fact finds you interesting.
That's a very good tip. Very good. Thank you for opening with that.
If I can add to that, I would say that when you hit the stand to testify, experts typically testify near or at the end of a case in chief. And as a result of that, the judge already has a tremendous amount of context in which to place that testimony. We've already heard the opening statements. We've heard from a lot of witnesses, and particularly if you're coming on for the defense, we've probably heard the entire case. As a result of that, if your testimony doesn't square with what's come before, it strikes us almost immediately that that's a major problem. And so to the extent you can inform yourselves of what's going on in the trial, some experts will sit through the entire case to see what's happening. It's very helpful because if your testimony isn't consonant with what we've heard from a lot of other people, we're likely to reject your testimony out of hand.
I would just add to that, and I can't resist taking a quasi-cheap shot at myself and other colleagues. The premise of the question is, what is the judge really thinking? The premise is the judge is thinking. Frankly, the judge may not be thinking, especially if the witness is boring, or the judge decides somewhere along the line that the witness, the expert, is not being helpful. Judge maybe has other things to do that day, and he or she may have brought work onto the bench. They shouldn't have, but they might have. Okay. So bottom line is we're all not alike. We're all either appointed or elected or both. We come from different backgrounds, hopefully. It'd be nice to have a little diversity. And if we do, it's because of somewhat to the extent of the political process. So don't assume that everybody thinks alike, and don't assume that they don't know. We don't know what we don't know. And we can learn from, my father used to tell me that you could learn from anybody. And then I took a course from a judge whose method of teaching was to cite string cites. And my colleague and I were sitting there listening to this, knowing it was a course in admiralty, and we shouldn't have taken it. And my colleague looked at me and he went, "I know your father told you could learn from anybody. Your father was wrong." Bottom line is we're not all alike, and really what we're thinking depends on what we're doing. If we're in a courtroom and the expert is testifying, again, you just heard from Judge Driscoll and Judge Yates, don't be boring, okay? Keep us entertained. If we're in a settlement conference and an expert is there, hopefully to help, I say hopefully because he or she may not be helpful. And if she or she is not be helpful, it's because they're too much of an advocate. We're in a settlement conference. We're trying to settle the case in a very comparatively brief period of time. And what the judge is thinking when an expert begins to pontificate and advocate is, why aren't you being helpful? Because that's why I wanted you here. So again, check the premise. If the result is not what you want it to be or expect it to be, that is the judge's behavior is not conforming to what your expectation was. It's probably because the expert's behavior is not conforming to the judge's expectation.
Great. I guess along those lines, you guys have brought up being boring and keeping things interesting, keeping things aligned. are there things that experts do, maybe with respect to their presentational skills, or maybe things like charts and graphs that either are always helpful or are pet peeves to you all for expert witness testimony?
So judges don't, why do we become judges? Well, we're afraid of blood. That's why we're not doctors. We're afraid of technology, right? And we're afraid of arithmetic. So make it easy on us to get to those points with slides or I used to call them oak tags when I was in Catholic school, 18 by 24 poster boards that illustrate the point you want to make. I think it is so important to have visuals, and particularly if you have a jury trial, and most of your cases, because most of our cases are bench trials, but if they are as a jury trial, jurors expect a little bit of glitz. So I think again, in the lines of making it interesting, also make it understandable, and some visuals will help you with that. I would say also, a trial is a human experience. Again, it is telling stories around the campfire, but it's stuff that happens in real time. So to be able to adjust your presentation to whatever the questions the judge is asking. I saw a question in the chat about, well, if we're excluded from the courtroom, how do we know what the judge is thinking and what the judge isn't thinking? First of all, I would ask your retaining attorney to make the application that you could be in the courtroom during key parts of the testimony. I've allowed it because my view is experts aren't going to shape their testimony based on what they hear. They're just going to be crisper based on that. So to ask, but if you're denied, ask the retaining attorney, well, what happened? What's been happening? How's it been going? What has the judge been focused on? So at the very least, ask the question. And then, as I said, when things happen during the trial, to recognize the human element of this. I'll just give you one example. I was trying a case, and the expert had his CV in front of me, and he was a black belt in 6 Sigma principles. And I said, "Oh, black belt, am I supposed to be a little scared?" And stone face, no expression at all. I said, "Your Honor, you're not familiar with the 6 Sigma principles?" I'm like, "Of course I am. I'm just trying to ask you. I'm trying to see if you're a human being underneath all that." So I think don't be afraid to be a human being. Also, we are human beings. We laugh, we cry. I took out the garbage last night like a human being. So that's what we do. We're human beings. Be a human being.
Great. So what about if the expert comes off with a cocky or a smug attitude? And I know every judge is different, but perhaps in generally, what is the judge thinking when an expert comes off as maybe overly confident?
Depends on whether they're smart enough, whether the impression is that they deserve to be smug or cocky. And if they are, wonderful, but usually they're not. And so the answer is, my mind, the answer is the attorney didn't prepare him or her very well, or they wouldn't be acting like that, because that's part of the preparation. And but really, if they're entertaining, if the expert knows what he or she is doing and projects that, and that could come off as cocky or smug to some and not to others. What was already said, I would just emphasize: a jury is going to react much differently than a judge. We're used to it, and that needs to be recognized both in the preparation and in the presentation.
I think that it never works well to appear to be trying to be the smartest person in the room. Richard Feynman, the Nobel winner in physics, once said that the essence of genius is taking the most difficult concepts and making them simple for everyone to understand. That's the best admonition I can give to expert witnesses. That's what you want to try to do.
Great. That's great. How about when maybe an expert has a bad day? Maybe their preparation wasn't great. Maybe the facts of the case just aren't in the favor of of what they're trying to show or explain. What is a judge really thinking when an expert doesn't handle cross-examination well?
My answer is the same as it was a minute ago. They weren't prepared very well. I think the attorneys bear a very heavy responsibility for that, because it's likely the attorney does know who the judge is and what the judge is like and what the judge thinks and how the judge approaches, and also knows the opposing attorney and whether there's going to be what kind of cross-examination. And what's that old saying? Preparation, preparation, preparation. But you can't be expected, you as an expert can't be expected to know what the attorney knows unless you've somehow independently researched is it a jury, is it a judge? And cross-examination is an art. If you've got the kind of experience that you know about it, great, but the attorney that's their responsibility to help you, to prepare you. And so if that happens, yes, it's your responsibility because you're the one on the witness stand being cross-examined and not doing well, but there's plenty of blame to go around, and it ought to be assessed.
One of the things that frustrates me on cross-examination, and this isn't just for valuation experts or any experts, but it really extends to anybody on the stand, is the witness who continually wants to go beyond the question asked on cross-examination. And either you answer the question yes, no, or I can't answer the question as phrased. The time to really give the full throttle explanations is on redirect. And so again, tying with what Judge Platt said, a cross-examination that's not going well is as much, if not more, on your retaining attorney than it is on you. And indeed, a cross-examination that's not going well should be able to be rehabilitated, or an attempt at rehabilitation during redirect examination. But the tip that I would give to anyone testifying on cross-examination, because it's so stressful, because the lawyer has control of the podium, because the lawyer has control of the questions, just pause half a second, quarter of a second before answering the question. Yes, okay, I can agree with that. I'm not sure I can agree with your premise. Whatever it is, just, be the measured expert you are, rather than getting in the trenches. As they say, never get in the mud with a pig. Not that lawyers are pigs. Never get in the mud with a pig, because you'll get dirty and the pig will enjoy it. I think I got that one from Judge Platt. So again, that's, don't get in the mud. The time to show just how great you are, again, is on redirect examination.
I ran a federal public defender's office for 7 years, and we had an office-wide policy that I insisted on, that anytime it looked like a case was going to trial, our client, the defendant, had to go through round after round after round of direct and cross-examination. And I have one of the best lawyers in the office do the cross every time. And I had the same policy with expert witnesses always. Nobody go out and play a basketball game or a football game without practicing. And it's crazy not to practice for cross-examination.
Great. How about, what is the judge thinking when the expert endures personal attacks under cross-examination?
What many judges, this judge including, does is, counsel, stop. It's enough. Let's stick to the issues. There's nothing persuasive about that at all. In fact, it just makes you bristle when you feel like you're in the middle of a, what was the bad Rocky movie? Rocky V, the street fight with Rocky and Tommy Morrison. I don't want to be there for that. I'm here to do a job. I'm not here to get in the middle of some, conflagration here. So I think that the judge is not only thinking that's not a good idea, but that's on the lawyer who is lowering themselves by asking you that question. So the advice I'd have from here is, as Michelle Obama says, float, don't sink. Don't sink down with them.
Yep. Be the better person. I agree completely with what Judge Driscoll said. Personal attacks have no place in the courtroom. I know that trial judges hate them, and I am quite confident that jurors hate them as well. And what I would do as a trial judge, if it were a jury trial, is call out the lawyer, and, not in a mean way at first, but to make it clear to the jury that that was a low blow. And if the attorney persists, then to be more aggressive and eventually take the jury out of the courtroom and yell at the lawyer to knock it off.
Exactly. Or another way of saying the same thing is, counsel, you and I both know better than do what you're doing. Stop it now.
Yep. Right. Great.
What we're hearing, the theme from the three of us is that, you know, speaking to a wayward attorney is much like we spoke to our toddlers. I mean, I knew, when I heard Judge Yates say, knock it off. That's what my father used to say to me when I was 5, fighting with my brother. But that's exactly what we say. Knock it off. That's enough. And as Judge Platt said, you're better than that. You're better than that. I know it's the heat of battle, but you're still better than that. So
Great.
let us do that. Let us do that. And again, that's where the pause between the question and the answer allows us, who are just listeners, to catch up and say, wait a minute, that question really was offensive. That I really heard that. All right. So to be able to pause rather than engage immediately allows us to do our jobs.
Right. Great. I wish I could ask you guys another dozen questions. I appreciate all the insight that you've given to us. I want to ask Michael Kaplan a question now from the expert's point of view. So Michael, oftentimes, you know, we're wondering how the judges are reading our body language, our tone, even our posture, and in addition to the actual words that we're saying. How have you been able to learn to read how the judge is responding to your testimony? Have you ever had any experience where it's been, you know, you've had clear insight into what a judge was thinking?
Thank you, Janae. That's a great question. And having clear insight into what the judge is thinking can often involve mind reading, and I'm not a mind reader. But I certainly understand the context of why I am there and what I need to do when I am on the witness stand. And no matter what I do, I always do it in the context of the phrase that Zach Myers often refers to, and that's unimpeachable neutrality. Never lose that on the witness stand. And this was a case where I was not in the courtroom during everything that went on in the trial up until my testimony. And I was the last witness for the plaintiff. And what I needed to do is learn from my retaining counsel what had gone on. What are the foundations of what went on in the trial that will help me understand and best present my testimony. So I met my retaining counsel at the courthouse at noon. She was going to put me on the witness stand at 1:30. This is a Friday afternoon. This was the 5th day of trial. She was putting on her case Monday through midday Friday. So she had 4.5 days. And when she saw me out in the corridor, she came over to me and she said, "Mr. Kaplan, I want to tell you that prior to the lunch break, the judge told me that I've done absolutely nothing to prove my case. So I'm depending upon you to prove the case for me." And I'm thinking, wow, that's quite a burden. You've certainly, you've certainly given me a lot of foundation that's going to help me, a lot of insight. And I realized that if this was going to come together with a happy ending for the plaintiff, that I needed to be particularly attentive to what it was that the judge needed to hear from me. And I will not be an advocate on the witness stand. But the first thing I needed to do was make sure that my testimony was as clear as possible, that it was as simplified as possible, that all of my testimony was supported by evidence, by the appropriate evidence. And it was, this was a fraud misappropriation case involving an accountant who literally misappropriated a client's funds that were intended to be paid to the Internal Revenue Service and the state taxing authorities, but instead the accountant took the money for herself. So I walked into the courtroom knowing what the score was, knowing what the burden was. And I took the witness stand. I was sworn in as an expert, and my retaining counsel looked up and said, "Okay, Mr. Kaplan, tell the judge what you have to say. And Her Honor looked down and said, counsel, that's not how it works. The way it works is you ask Mr. Kaplan a question and he answers your question. Well, with her first question, I understood why she was not able to prove her case prior to my testimony. And it took her about 4 or 5 attempts. And the judge shot her down after each of the first 4 or 5. And then she finally got to one that let me tell my story. And I realized I said, this may be the only question that I get that will enable me, where the judge will allow me to give an answer. So I just took it and told the story. But I knew that the judge was, this was not a jury trial, it was a bench trial. I knew what the judge's mindset was. I told a story. You know, my testimony started with once upon a time, everything in there was logical, supported by the evidence. It ended with, and they lived happily ever after. But I did my best to connect with the judge. When opposing counsel was cross-examining me, I answered all the questions very open and candidly. And when I'm on the stand, that's the way I approach it. You know what I mean? And I know that when I'm in the courtroom, the minute I'm sworn in, my client is the trier of fact, be it the judge or jury. And that's what I'm there to do, to enable the judge or jury to better understand it. And I knew it was this one judge. So when I was on the stand for about 2 hours, and at the end of my testimony, I mean, there was direct and cross and redirect and recross. And I was expecting the judge to look at me and say, okay, Mr. Kaplan, you may step down, you're excused. And she looked at me and she said, Mr. Kaplan, I like you. You're the only witness in this trial that I really understood. Do you have a CV or a resume that I could have? And I'm thinking, okay, I may have done my job here. So I had an extra copy of my report and I undid the staple, took my CV out of that, put a paper clip on it. I handed it up to the judge. So, the case had a happy ending for the plaintiff. When it was all over, Her Honor awarded every dollar that was asked for in the complaint, plus treble damages, plus all costs, plus all attorney's fees and costs. And I just knew, I knew where the judge's head was. I knew what the judge was thinking when I took the witness stand. And that I always had to be cognizant of the fact that my testimony had to tie into the storyline, counsel's theme of the case. It had to be truthful, it had to be reasonable, it had to be logical, but I connected it to the storyline of the case, very respectful to everyone in the courtroom. And the judge was happy, everyone was happy when it was all over. But I'm always thinking in terms of my audience, what their mindset is, what they are thinking, the judge, the jury, and that's the way to be an effective expert and tell a story. I mean, you cannot underestimate the importance of giving your testimony as an interesting story that brings the trier of fact into it.
Great. As always.
I rest my case.
That's great. Thank you all. Thank you, judges. Thank you, Michael. It's been great, and we'll see you next time.
Thank you, Janae, and all the judges and Kaplan for all that information. So now, sorry that we are running over, but we have Todd Zigrang and Jessica Bailey-Wheaton. They are going to talk about healthcare valuation, industry updates, and what to expect in 2024. So Jessica, Todd, you can take it from here.
Thank you very much. My name is Todd Zigrang. I'm joined by my colleague, Jessica Bailey-Wheaton, who may be above or I guess below me. I'm in the order of the pictures I see, kind of like the Brady Bunch here. But yeah, we're looking forward to being in Fort Lauderdale in December and talking about industry updates in 2024, which seems just odd to me. And I just finally got the hang of writing 2023 in all my correspondence, and I'm going to be asked to speak about what we expect to see in 2024. We have a PowerPoint slide here. Yeah, thanks. And in our presentation, we've been asked to talk a little bit about what we're going to talk about here in December at the Fort Lauderdale presentation, but it's all going to start to evolve around what we call the 4 pillars of healthcare valuation. And this is a conceptual construct that allows us as appraisers to do the due diligence, consider the risk, and allow for us to be a proxy for the typical universe of buyers, sellers, investors in the transactions that we're being asked to appraise. We can group these into regulatory, reimbursement, compensation, and technology. And
competition, I think you meant, Todd. I know you got competition on the brain today.
oh, thanks. And regardless of our engagement for the valuation of whether it be enterprises or businesses, specific assets, whether it be tangible or intangible, and we're in healthcare, so a growing component of a business are the intangible assets of the service. Where these are service industries and service businesses that we're being asked to appraise, as well as different types of services, whether it be compensation of positions of executives. We're doing an engagement right now for that. Management service arrangements, as we see more traditional non-healthcare companies getting into healthcare, and because of the different regulatory things that we have to consider, corporate practice of medicine and such so forth, there are management service arrangements that we have to opine on so that there is so they're legally permissible to participate in these types of transactions. And so some of the engagements will include evaluation of many different types of assets, services. And so the days of just a single business valuation, one element that we're appraising, seem to be gone. With half of our engagements involve different elements that we have to appraise, working together with a whole lot of moving pieces and what ifs throughout the negotiation of a transaction. And we're dealing with a perfect storm in healthcare. Well, we've been saying that for 20 years. It's continued. There's certainly a rise in healthcare expenditures. The number of individuals that are underinsured, non-insured, it plays a large impact on the valuation. We're seeing the baby boomers are still increasing, and as we know that people's use of healthcare increases in the last years of life, so we're seeing an increase in demand, coupled with a decrease in provider manpower availability, whether it be physicians. We're seeing more mid-level APC type providers trying to take up the slack. We're seeing technology that's participating in helping take up the slack. So there are many different catalysts there. We have healthcare reform, which I've been hearing about since 1993, and healthcare, what one person defines as healthcare reform is different from another's. So we have that, as well as the economic conditions that are playing an impact within healthcare, whether it be the rise of interest rates, unemployment, the market, and so forth. So all of these play a huge part in the appraisal of healthcare enterprises. Again, we're talking about reimbursement, where we're talking about shifting of payer reimbursement scenarios from fee-for-service medicine to value-based reimbursement models. That's playing a big part in the valuation and what's driving a lot of the transactions that we're seeing. Regulatory, certainly, I think, of any of the 4 pillars, drives the need for our services, whether it be the increased regulatory scrutiny from Stark, anti-kickback, and other fraud and abuse laws. What's legally permissible as far as a transactional structure one day is not legally permissible the next. And so there's oftentimes that we're being asked to change the model and appraise the same thing in a different way because was once legally permissible, not so much a couple of years down the road. Competition. competition used to be, with the hospital next door, the medical practice down the street. It's become global in a sense, and not just of like horizontal consolidators, but of vertical integrators, of organizations that aren't participating in that market segment that in a traditional manner that we have to think about. There's the CVS's, the Walgreens, the Amazons, Apple getting involved as well. Private equity is a large player in healthcare consolidation and transactional activity. Then again, there's technology. Right now, we're writing an article about how artificial intelligence is playing an impact in the delivery of healthcare and how that may impact how we appraise businesses, what's driving the M&A activity in healthcare. So again, that's things that we have to take into consideration here in part of the due diligence of the conceptual framework in which we're appraising enterprises, services, and assets.
So taking what Todd just talked about, kind of that basic construct of the 4 pillars, that's kind of how we plan to approach our session in December when we're talking about, healthcare updates and healthcare valuation updates that's happened this year, and maybe what that means for 2024, as much as one can predict. So I put up here a couple of the topics I think we'll be talking about. I kind of put an asterisk beside all of that because with the possible government shutdown that may happen between now and our session, that could change, a lot of what we talk about. The government, at least right now, is open until November 17th. So come November 17th, November 18th, all of this may change, but for now, this is some of the things that we're seeing as big industry updates that we'll talk about and how that's affecting what our clients are doing, how they're operating, and what they're asking from us as a result. So some of the things being, again, COVID-19, the public health emergency did end earlier this year. That meant that some of the waivers and flexibilities ended, but a lot of them actually have been extended until the end of 2024. And actually, as recently as today, I saw headlines come across that there were some of those flexibilities and waivers put back in place until the end of 2024. So while, I think a lot of us think of COVID as in the rearview mirror for the healthcare industry, they're still dealing with a lot of these changes. For 3 years, it's been one way. Now it's transitioning to another way, and just trying to navigate that. By the time we have our session in December, hopefully all of the 2024 fee schedules will be finalized by CMS. We'll be able to talk about what those reimbursement changes are and what that means in terms of the work we do, especially in the healthcare compensation space. There's been a couple of U.S. Supreme Court decisions this year that directly affect the healthcare industry. It looks like there could be a couple more in the next term that just started here at the beginning of the month. So we'll review those and then talk a lot about the government, where the government's really spending their time and their focus right now. And right now it's really on competition and on technology. So those are, I'd say, the 2 of the 4 pillars that we don't always spend a ton of time on, but I think in recent years, those have really been pushed to the forefront. So we'll certainly be giving them, I think, a fair amount of attention during our session in December. And Todd, I'll pass it to you to talk about maybe how some of those updates are kind of changing what we do and how it's updating our work.
Right. During the presentation, we certainly will touch on the subsectors in healthcare that I think most of us have some kind of involvement throughout the year. Your traditional healthcare subsectors such as hospitals, physician practices, ambulatory surgery centers, diagnostic imaging centers, and the like. We'll talk about what the transactional activity we've seen in 2023, where we see it heading in 2024, things to look out for as far as trends, some in the different pillars, how that's impacted, what we're seeing as far as reimbursement, how that may impact, certainly competition and technology for those. But there's other areas of opportunity other than the traditional healthcare subsectors that we'll touch on. That one being healthcare data. We wrote a article for NACPA earlier this year on healthcare data, where we've actually several engagements appraising the sale of healthcare clinical data. Also health tech. We're seeing a lot of startups in the biotechnology areas in healthcare. And last December, we spoke about valuation of startups. That's a large part of what we're seeing in healthcare as, again, non-traditional healthcare providers getting into the healthcare space, trying to get out ahead with the technology that's been developed to help facilitate the care of patients in shortfalls as far as health equity, diagnosis, and even treatment. So there's that intangible asset, or even the businesses that comprise the intangible asset of the healthcare technology and the patents and all the intellectual property that's involved there. Different types of services, whether it be remote patient monitoring, remote therapeutic monitoring, those types of services that are now being accepted by CMS and being paid for by CMS. We're seeing not only the providers that are providing that, but the ancillary service providers, whether it be pharmaceutical dispensing, wearables, those that are now being reimbursed by healthcare, by payors, playing a part in healthcare. And how do you divvy up that healthcare dollar between the provider and the non-provider of the totality of the services that are being provided? And because of also the impact of private equity and other non-traditional healthcare providers participating in healthcare, we're seeing a whole lot of management service arrangements that require a valuation as far as what's the fair market value of the management fee being paid by the providers to the management entity. That has to be at fair market value to allow for this to be part of one of the exceptions that they are allowed to be legally permissible. So we're seeing a lot of activity in that space. And what are some of the things that we look out for and have to consider when doing that kind of those types of arrangements? Physician compensation. You can say what you want about the M&A activity. However, physician compensation is typically an annual practice for hospitals and their arrangements with providers and even sometimes non-providers, that they are within the bounds of fair market value, so they can be legally permissible from the fraud and abuse laws. And as we get into the advent of how entities are being reimbursed on a basis of value rather than volume, how those compensation valuation assignments are changing. Different things for consideration. We certainly always had the RVU, the relative value unit metric, as a measure of productivity or economic input by a physician to an organization in which they're compensated. Now there's other elements being brought in other than just the putting hands on a patient, or even, I guess nowadays, even video chatting and diagnosing through other telehealth means. But there's, as far as outcomes, reduction of costs, how is a physician being compensated for that? How is it being measured and monitored so that we can quantify that compensation? So that's a large part of our practice and what we're seeing in an opportunity for appraisers to participate in healthcare valuation activities.
And I would say, to add on to that, Todd, I think we're being brought in more sometimes in a strategic role in addition to the valuation role, because of, with, I think, post-COVID, a lot of healthcare systems especially are looking to possibly tweak and change their compensation arrangements with physicians, like you said, to move maybe more toward value-based care or to correct some deficiencies they saw during the pandemic. Now that they're kind of head above water with that, they're looking to the future, and they're looking to see how they can make those changes, and in a lot of ways looking to us to help guide them on that.
Right, you hit the nail right on the head there, and trying to get out ahead of the needs. And I think you're right. Whenever we saw with COVID, they saw some deficiencies in the way in which they're compensating physicians. They want to build a model that not only withstand that, but be more forward looking, because that's where we're seeing all of our clients moving towards the value-based reimbursement and what comes first, the chicken or the egg? Does the reimbursement model happen, the change in the reimbursement, or the compensation? And sometimes it's the tail wagging the dog in that case. Other things that we're seeing, while compensation types of transactions are increasing, we're also seeing, again, M&A is a large part. I don't see that slowing down, even with the increased regulatory review concerns that we've seen, higher interest rates. We're seeing sometimes higher elevated valuation multiples, potential recessionary fears of the individuals. And we certainly coming up this next year, we have another presidential election, how that might impact some of the M&A transactions and activity that we're seeing in healthcare.
Great. So I think our time's up. So if anyone has any questions, feel free to message us offline or attend the session in December, and we'll happily discuss all your questions.
Thank you, Jessica and Todd. And now we are going to have Will Casserly. He's from Hinge Marketing, and he's going to be talking about how ordinary experts become industry leader. But we have one of our polling questions too. So make sure you respond to that. Will, you can go ahead.
Hi, Alina. Thank you very much. Can we see the share screen? Are we working?
Yes, I can see the book.
We'll get started. I want to thank everybody for such wonderful information and sharing so far today. It's very interesting. So welcome and welcome to the revolution. So today we're sharing some findings from Hinge's newest book, which is called The Visible Expert Revolution: How to Turn Ordinary Experts into Thought Leaders, Rainmakers, and Industry Superstars. So what do we define as a visible expert? Well, the easiest example is all the great experts we've heard today thus far. So think about Mike Gregory, Mel Abram, Alina, James, Lari, Carla, Ken, Judges Driscoll, Platt, Yates, all great information that they've shared. It's all educational, informational, and the AVW forum is just a great place for this. So we want to talk about the revolution itself a little bit. There really has been a fundamental shift in the last few years about how professional services are being delivered. We've seen a big shift in buyer behavior. People no longer rely only on word of mouth referrals. Think about it. Individuals have access to web search, listening to different speakers, blogs, articles, reports, attending webinars like this. Conferences, you're deluged by social media, and all of that. A lot of that is all driven by technology. So we have AI, we have search engine results, and it's really made information available to us anytime, anywhere. And it's also caused a change, especially since COVID, of change of what we call geographic boundaries. Those walls have really been torn down. We can now meet virtually from almost anywhere, and we can do business from almost anywhere. So throughout this presentation, the next couple of slides here, just consider how visible expertise can benefit you and your firm, but also think about how it applies to the firms that you work with. Are they implementing similar techniques and strategies in their own businesses? So Hinge does a lot of branding and marketing research, along with the helping companies with their branding and marketing. And we found in our research over the past decade, roughly, or even longer, 15 years or so, that visible experts are one of the keys to success for professional services firms. In this latest research, we've spoken with over 220 visible experts themselves to understand how they gained the notoriety that they have, and along with interviewing 275 of their clients to capture their insights. And we've also profiled 9 in-depth case studies within there. So in other words, this isn't just another business book. It's really grounded in research. So why is all of this important? Well, when you cultivate individual experts within your firm, the entire firm benefits from what we call the halo effect, or what's been dubbed the halo effect. So with these findings, you have the ability to grow your expertise faster than ever before. We've found out kind of what those visible experts are doing, what they're doing differently, what they're doing the same, how they found success along the way. So why many of them have taken a long track of learning all these things, we've really taken all that information, boil it down, and find out what works for them and what could work for you as well. So, when we think about the halo effect, we think about, if buyers have a strong positive feeling about an expert, a visible expert, right, they're likely to have that same feeling or about that expert's firm as well. It kind of carries over. So visible experts can benefit their firms, and they can benefit them in the ways of growth, reputation, partnerships, fees, closing rates. So making experts visible almost automatically makes those firms visible as well. And not all visible experts are the same. So we've come up with a couple different categories of people. Some of the ways that they implement their visible expertise. Some of them may be known as what we call bridge builders, where they span two different areas of expertise and they connect ideas from both those expertise. For instance, we may take technology on one side and then combine that with a specific industry, such as what we were talking about with a little bit of healthcare. So really specializing in a certain area and not being too broad. We also have what we call lasers, who are very highly specified in a very specific area. We have a category which we call curators. Think about Mike Gregory, right? Extensive networks, and they gather the very best information from multiple sources, and then they pass that along and share it. We also have the type of visible experts we call first movers, people who are really on the cutting edge of their industry and really sharing the latest, greatest information. And we also have what we dub contrarians, those who take maybe a novel point of view and really challenge the industry norms with maybe something a little bit more unconventional. So why do we care? Well, numbers are a big difference. When we look at the different levels of visibility from level one, who might be what we call a resident expert or a resident in-house expert, all the way down to level 5, which would be a global superstar, a household name. Research really validates that the visible expert contributes a significant impact on this firm's revenues. So one of the things we did was we looked at individual billings. And visible experts at almost every level commanded premium rates, starting about 200% at that level 1 for the baseline visible expert, and all the way up to level 5, which that global superstar, thinking about household names, thinking about people like Warren Buffett, who really made a name for himself, commands almost 10 times more than a normal professional, average professional within the same place. One of the questions we also asked, and people when we're talking about this is, what challenge limits you from increasing your visibility online with your firm's experts? And we get a range of responses from that. Number one, though, reason that people fail to do this is their experts are too busy. They're unavailable. They don't have enough time. So there are ways to manage around that. They're also concerned sometimes with the cost of a formalized program, perhaps sensitivity to marketing, a new marketing initiative, and a lot of times they're just really not sure where to start. So visible experts are central to how buyers evaluate potential service providers. We looked at the top 5 responses that people gave. And the first 3 in understanding this are all around expertise, knowledge of the industry, relevant experience or past performance, along with the talent and expertise of the staff that's involved. A little bit further down in the buying decision, we also asked, like, what was the scale tipper? What was the final thing that made you decide to choose a firm to work with. Number one was existing relationship. So we're seeing that more than ever, buyers are really attuned to how qualified you are to help them solve their top challenges. They looked at relevant experience, past performance, and the talent in this team and the results. So heightened visibility also offers a wide range of advantages. Here we're looking at the top benefits of visible expertise. And while personal, flexibility and providing a platform for their personal message are important to individuals, the leading benefit was the way that visible expertise boosted the brand overall. So it's not just about increasing your own visibility, it's about enhancing the firm's brand. Another benefit is ability to support recruiting or retention. Let's go back and think about the halo effect again. Talent attracts talent. So when we have great visibility for our experts, we have great visibility for the firm, it attracts more talent to the firm. So the book goes through in very high detail, but some points to note when beginning your journey of becoming a visible expert. Where do you start? The experts we interview wish that they started earlier on their visibility. It takes time to build these things. And so I think a lot of things that we found in the research were how to do these things more efficiently and start getting those results more quickly. But the sooner you start, the sooner you can start building more visibility for yourself and the firm. Specialization accelerates the journey, really defining exactly what you're going to do and why you're going to do it. And ability of willingness to take an original stance, and also a discipline and consistency. We know this thing, you have to be consistent. Take the AVW forum. This is a regular occurring forum that happens. And wherever you're leveraging your visibility, it needs to be methodical and repetitive inside of that. So breaking it down and following a specific set of steps will help you get your goal. Make sure that you're positioning yourself clearly. Can you concisely define what you do, who you do it for? Have you selected issues and topics that you'd like to speak about? Also understanding your audience and doing the research necessary to be able to understand them. How is your perspective different from others in your field? And have you researched the best ways to reach your audience? And finally, build your visibility plan, play to your strengths, and develop a formula that works for you. If that's presenting, some people work better in that format. Some people are stronger writers. Some people are great speakers, and podcasts lend well to that. When we polled our visible experts and found out where they were spending most of their time and effort and finding the most results, this is a great illustration of kind of where to speak. Speaking engagements are always great. If you have the time, ability to craft a book, that's always a great driver too, and on down the line. So if you're interested in learning more about this, please visit us on our website. The Visible Expert Revolution is available on Amazon.com, hardback, softback, Kindle version as well. And for firms who are interested in our extended course or Visible Expert programs, please reach out and contact us for more information. Love to connect on LinkedIn. Just shoot me a link. And hopefully we got us here on time, 3:02.
It's okay. Thank you, Will.
Thanks,
Thank you for all the great information. So, and thank you everyone for joining us. And you are invited to attend our next month broadcast. It's going to be November 13th. And remember, if you want to participate on the next conference in December, it's going to be for Lauderdale and virtual. So make sure you register for that one. So everyone have a great week. Bye-bye.